Welcome to Multifamily Millions, building lasting wealth through strategic apartment investing. Real estate can feel overwhelming at first. So many people get stuck flipping single-family homes, hoping for quick returns, only to find inconsistent results and burnout. But multifamily properties, they offer something different: scalable cash flow and the ability to mitigate risk across multiple tenants. Notice here, even one vacancy won't derail your entire income, unlike a single-family home. David Lindahl started with just $800 and in just 14 months reached $10,000 per month in cash flow by focusing on value-add strategies. If you want a step-by-step guide to follow along, you can download the PDF linked below and make sure to subscribe so you don't miss the deeper lessons we'll uncover. Let's talk agenda. Today, we'll explore why multifamily investing works so well, break down key lessons from David Lindahl's playbook, look at actionable takeaways you can implement immediately, reflect on your own investing mindset, and wrap with a clear path forward. By the end, you'll see how even small, disciplined actions can compound into meaningful wealth. Why focus on multifamily apartments in the first place? Well, think of them like a portfolio in miniature. Multiple units mean your income is diversified. One empty apartment doesn't wipe out your cash flow. Lindahl's journey proves this. He leveraged small, underperforming properties and systematically turned them into steady streams of income. That's the difference between a gamble and a strategy. Imagine starting with minimal capital but using the right systems and market knowledge. That's what David did. He looked for value-add opportunities, upgraded units strategically, and grew a small seed of $800 into consistent cash flow. This slide shows the foundation: discipline, research, and action. Lesson 1. Multifamily versus single-family investing. Why shift? Diversification. With multiple tenants, your risk spreads out. A single vacancy doesn't collapse your income. Steady cash flow funds your next investment faster, which is crucial if you're aiming for financial independence. Start small. Even 2 to 4 units can teach you the systems you'll use for scaling. And focus on Class C properties in emerging markets. These often yield 20 to 30% ROI through strategic repositioning. As you see on this slide, small, intentional steps can compound remarkably. Lesson 2. Debunking myths. Many investors think you need years of single-family experience before touching multifamily properties. That's not true. Real knowledge comes from action, not hesitation. Lindahl himself took micro-actions, analyzing one deal per week, building confidence as he went. Outsourcing management early allows you to handle complexity without being overwhelmed. Notice how Aristotelian logic applies here. Learning happens when you engage directly, not by overthinking. The takeaway: start small, stay consistent, and challenge your limiting beliefs. Lesson 3. Sourcing profitable deals. The magic is in finding underperforming Class C units that can be repositioned. David built relationships with brokers, sent direct mail to absentee owners, and even drove for dollars, literally scouting neighborhoods for opportunities. Analyzing quickly is key. Don't rely on assumptions or surface numbers. Dig into P&L statements and occupancy rates. Deals can be missed if you hesitate. The slide illustrates that consistent sourcing and relationship building lead to a pipeline of opportunities, the backbone of any successful multifamily portfolio. Lesson 4. Analysis and due diligence. Here's where many beginners stumble. It's tempting to trust pro forma numbers, but Lindahl emphasizes using actual financials. Verify 3 years of P&L, inspect units personally, and apply the 50% expense rule for quick screenings. Thorough analysis prevents costly mistakes like hidden repairs or overpaying. This step isn't glamorous, but it's the foundation of confidence and predictable returns. As this slide shows, precision in numbers protects both your capital and your peace of mind. Lesson 5. Creative financing. Many people think they need a huge bank account to start. Not true. Lindahl used private money at 7 to 10% interest, seller financing, and broker connections to fund his deals. The key is preparing strong packages, deal summaries, resumes, and clear financial projections. Focus on deals where the numbers work, not your personal capital. You can scale without draining your savings, turning limited resources into opportunity. Lesson 6. Repositioning for NOI. Net operating income drives property value, and small upgrades can make a big difference. Start with the exterior to boost curb appeal and occupancy quickly. Selectively improve interiors, paint, appliances, lighting. Monitor NOI quarterly and adjust strategies accordingly. Remember, strategic improvements compound over time, turning underperforming properties into high cash flow assets. This is where vision meets execution, elevating each property to its full potential. Lesson 7. Building a management team. You cannot scale by yourself. Lindahl recommends hiring IRM-certified managers to maintain 95% occupancy. Interview extensively, check references, and enforce standards. Mystery shop managers to ensure accountability. Strong teams multiply your efforts and free your time. The slide illustrates that real wealth comes not just from properties, but from the people you empower to run them efficiently. Actionable takeaways. Prioritize $100 per door in cash flow and vet every deal carefully. Focus on Class C value-add properties, nurture broker and lender relationships, outsource management, and track quarterly performance. Start small, track your wins, and scale systematically. Every small, consistent action compounds, creating a foundation for financial independence. Now, reflection. Which barriers, financial, psychological, or operational, have held you back? How could adopting multifamily strategies transform your path? I'd love to hear your thoughts. Comment below and let's discuss how you'd tackle these challenges in your own portfolio. Conclusion. Strategic apartment investing is accessible to anyone willing to combine disciplined action, creative financing, and strong team building. Start with one small deal, source it through brokers, and scale consistently. To make these steps actionable, grab the PDF in the description, subscribe, and hit the notification bell so you never miss insights like these.